Hello friends, a very warm welcome to my channel. In this video, we are going to discuss in brief about Kaynes Technologies. This is a very interesting company in the electronics manufacturing sector. So this sector has huge tailwinds post-COVID as the demand is shifting from China to India, and globally all the companies across the globe want another manufacturer in addition to China. So even if India gets about 5 to 10% of the manufacturing volume which China has, the demand in India can become 5x, 10x from here. So this kind of tailwinds are existing in this particular sector, and this company is capable in terms of research and technology to take the advantage of these tailwinds. If you are new to the channel, please do subscribe and hit the bell icon to get the updates of all the new videos which I upload. And if you are not a part of our Telegram channel, do click the link in the description button and join today so that you join the right Telegram channel. Every day morning before the market opens, I share my view on the markets, which will help you manage your portfolios and increase your returns much higher. So let's begin the analysis of Kaynes Technology. We'll start with discussing the business model of the company in brief. We'll look at the stock performance in the last couple of years. This is a recently listed stock. We'll discuss the main financial parameters of the company. We'll talk about why the stock has rallied so much in the last couple of years. We'll discuss the outlook of the management. We'll talk about the valuations. We'll discuss the risks of investing in this company and then form an overall view about the investing. So Kaynes Technologies is a design-led manufacturing company. So it has integrated manufacturing facilities right from the concept of a product, followed by the design, prototyping, then manufacturing and development, delivery, and after sales service. The entire value chain is handled in-house by this company. How is this possible? This is possible because they have 9 manufacturing companies, and it is a research-driven company with more than 75 engineers working in their R&D full-time. Now, what kind of products does this company develop? They manufacture electronic products which are used in sectors like aerospace, defense, railways, consumer electronics, medical technologies. So they have till now catered to 350 plus customers across the globe, which includes different multinational companies, and they have served more than 26 countries. So just to give you an idea, these are the products manufactured by the company in automotive sector, which forms a part of major revenue of this company. They manufacture cluster PCBAs, LED headlamps, then switch PCBAs. In the industrial sector and the EV vehicles, they manufacture engine control panels, street light controllers. Then they are also manufacturing products for railways such as UM71 receivers. So we will not get into too many technical aspects, but broadly you can understand that they are into manufacturing of products used in railways, medical, aerospace and defense, and IoT and IT enabled products like barcode scanners and RFIDs, etc. When you talk about the customer base in different verticals, automotive constitutes about 31% of the business of this company, so they have a huge exposure to this sector. Then the industrial and EV constitute about 44% of the revenue of this company. Then the remaining part of the revenue is distributed majorly across aerospace, medical, railways and information technology. When you look at the stock performance post listing, it consolidated for a while and then the rally upwards has begun. From then onwards, there is a steady rise in the stock price up to the levels of more than 3,000, and thereafter the stock has been consolidating sideways. You should also note that the company has done QIB placement and raised funds at somewhere around 2,400 rupees. So this zone will actually act as a short-term support for this particular stock. And if you look at the chart, you will notice this happening. The stock is building a base around this zone itself. So 2200 to 2500 would be a range where there could be a strong support for the stock. And ideally this range would not break unless there is a underperformance in terms of results of this company. If you look at the revenue performance, there has been a steady and consistent rise in revenue. The company did a revenue of about 368 crores in FY20, and FY21 being a COVID year, you don't see much rise in the revenue, but thereafter it increased steadily to about 1500 crores. So there has been 3 to 4 times increase in the revenue in the last 5 years. You will see a similar trend in EBITDA, which has gone up from about 40 crores in FY20 to more than 200 crores in the trailing 12 months. A slight expansion in the margin can also be observed. Earlier the company was doing somewhere around 12 to 13% margins, and now it has improved to about 14 to 15%. And the company is positive that as they scale going forward, there could be a further margin expansion. Right now, the company is doing a run rate of order inflow of about 279 crores every month. The inventory days about 191. So this shows that there is a lot of working capital which is locked into the inventory in this business. In terms of price to book, the stock is very expensive. It is trading almost 16 times the book value, and the debt is not substantial, but still it is an increasing trend, so we should keep a watch on the debt. Earlier the operating cash flows were positive, but in FY23, because of the rise in inventory levels, the operating cash flows have turned negative. So efficient working capital management is very important for this company going forward. Now, what led to the sharp increase in the stock price in the last 2 years? The sector has huge tailwinds as the Indian market in the electronics manufacturing sector is growing. The consumers in India for these products are also increasing day by day because of the rural demand and adaptability of smart devices in India. The government is also pushing the semiconductor sector, and when you observe in terms of numbers, there has been a steady increase by more than 30 to 40% in revenue in the last few years. There has been slight margin expansion, and the re-rating of the stock in terms of the PE multiple has already happened. So all these factors, which is a recipe for multi-bagger returns, have played out well in this particular stock. That is why the stock has given such high returns in the last 2-3 years. Now, what is the growth outlook of the company going forward? Right now, the company has an order book of roughly about 3,780 crores as on the end of December 2023. So this shows that there is clear visibility of growth at least for the next 1 or 2 years in this company. The company will continue to focus on the box build capabilities, which means that from scratch, from the design stage till the completion of the product, the entire development of the product will be done in-house. Even for the new products which the company is manufacturing, that will be the focus of the company. They will keep adding new products in different verticals which they cater to. They will focus on the sunrise sectors like the EV vehicles, aerospace, defense, railways, which will increase their margins going forward. The company is also continuing to do capex in the new products. They are doing backward integration in the semiconductor space, which will lead to the margin expansion, as well as the capabilities or use cases of their products will increase drastically. The company is also developing products like Kavach for the railways, which will be launched very soon, and the company is open to inorganic growth as well. They are focusing on AI-driven cybersecurity products. They have recently acquired a company called Digicom Electronics. The company hopes that the margin expansion will happen further going forward, so the EBITDA will go upwards of more than 15% is their expectation. So by reading all this, you get to know that the demand visibility is there, the focus of the company on the sunrise sector is there, the capabilities are getting built up as they are doing backward integration. So on the growth front, the growth plans are really impressive for this company. When you look at the valuations, right now the stock is trading at more than 100 times the earnings, which is very expensive. But these kind of stocks will not be available at a very cheap valuation because they are operating in sunrise sectors. These companies have niche in-house developed technologies, as well as they are having clear visibility of growth for the next 2-3 years. So the valuations will remain expensive for such companies, but that doesn't mean that you are ready to pay any valuation which is above the multiples of hundreds here. Another thing which you should remember when you talk about valuations of this company, as the company has done QIP at 2400 range, that will also act as a support base for this stock. So the conclusion here in valuations is the re-rating which is supposed to happen has already happened in the stock, and going forward the growth in the share price will be equivalent to the earnings growth which this company brings. Now, what are the risks of investing in this company? The stock is trading at very high premium valuation, so if at all there is underperformance in the results, then the stock can be beaten out badly. The promoters have diluted their holding even post the public issue, and it has come down to about 57%. If they don't manage their working capital well, and if they raise further funds, then it can further go down. So we have to keep a watch on the promoter holding. In terms of working capital, this company has to be very efficient. They should focus on the R&D because the entire business of this company is dependent on research. If they become obsolete in terms of their products, then the demand will drastically come down. The company is dependent on sectors like automotive and industrial products. So any slowdown in these sectors will impact the revenue of this company. And whatever the company is developing, the new products should be accepted by their customers. If at all the customers have issues with the new products developed, then the demand may be hampered for the next few quarters. So now that we have understood the business model of the company, the stock performance, the valuations, the growth outlook of the company, and the risks involved in investing in this business, what is your view on the stock? If you are already invested in Kaynes Technologies from lower levels, you should continue to hold the stock, because although the stock is trading at premium valuations, but there is clear visibility of growth and the company is working in sunrise sectors, so it may surprise in terms of earnings going forward. But if you are a new investor looking at investing in this stock, then at the current valuations, the re-rating has already happened. So either you should wait for a dip to accumulate this stock, or you should accumulate at a very slow pace during market corrections. So that's about Kaynes Technologies. I hope you like the crisp analysis. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, don't forget to mention in the comment section their names. Do join our Telegram channel using the link in the description. Thank you for watching and have a wonderful day.